Thanks for tuning into Bloomberg Quint. Essel Group's promoters have been given a longer rope by the lenders. The debt trap company now has time till the end of September to bring in a strategic investor and deleverage its accounts. Now, a large chunk of the creditors are mutual fund houses who have now effectively promised to wait for Subhash Chandra and his family to find a suitor and seal the deal. This in turn translates to a larger chunk of the investors' money staying locked in for a longer period of time. So should the retail investor be put through such a move? Let's ask two people who both would have opinion on the legal side as well as on the mutual fund side, Dhirendra, Kumar and Nirav, Shah. Gentlemen, both of you, thank you so much for joining in. Dhirendra, to your mind, is this in the minority or the mutual fund investors' interest that funds have agreed to do this agreement? The simple point is, how is one to know what will happen to Z's prices or the prices of those bonds by the time the deal is sealed?
One, it's an agreement of convenience. They don't have a choice. The other is that, there is always a problem when the underlying is, mutual funds run open-end funds. Mutual funds' total exposure to the Z entities aggregates to based on our data. It may not be exhaustive. Is about 4,082 crore, and it has exposure of 8 companies have their exposure, and quite meaningful one, Aditya Birla Sun Life being the prominent one, the leading one, accounting for close to half of it. So this is they didn't have a choice. The other is that the borrowing is from the entities. And Z Entertainment shares of the promoters is there as a collateral because those entities are not credit worthy enough to borrow it on their own strengths, on their strength of their balance sheet. So because most of them are either loss making or struggling or cannot support the kind of cash flow with their cash flow to support the interest payment periodically. So this kind of exposure, I think it is entirely driven by convenience. They don't have a choice.
Okay. For the purpose of this conversation, I will not go into what the funds could have done when they first went out and got these loans going, because that's a thing of the past. We're essentially trying to talk about what happens next. Nirav, what happens in the event of the prices or the values of these different assets, whether they are the ones that are held as collateral or otherwise, being substantially different than what they are when a deal of this nature has been entered into, because a minority investor might stand to gain if indeed the funds don't enter into a deal like this and liquidate the value that they have right now. He also stands to lose because if indeed the Z Group manages to reach a deal at a convenient point of time, and if the asset values move up, then it's in his benefit. I mean, how does one approach and dissect this whole issue?
So to be frank with you, I think the risk appetite for retail investor may or may not be the same with respect to the risk appetite of an AMC or a mutual fund house. So what circumstances the retail investor may find conducive either to hold on to the investment or to exit may not necessarily hold true for the fund houses. Having said that, I think essentially what we are doing here is speculating, because we really cannot tell as to what will happen at what point of time with respect to the price of the Z scripts. So to my senses, after having made this deal with the company and the promoters of Z, I think the mutual fund managers would probably have to take it one day at a time and assess the situation as it comes. And if they feel that this arrangement that they've arrived at eventually may harm the investors, then I think it might be time for them to pull the trigger.
Just wondering, Nirav, just to get the legal opinion out here, they've entered into a formal legal standstill agreement, right? I mean, are they, or if indeed the values collapse, if indeed, and I hope they don't, but if indeed they do, would the funds be able to go against and violate this agreement that they've entered into and sell off the assets that they have or liquidate the positions that they have?
So I would actually go back to the first principles here. So while I don't have the benefit of the agreement that the AMCs and the lenders have arrived at with the promoters of Z, but I would imagine it will be some sort of an arrangement where they would defer any legal action on certain assumptions and promises that would have been made to them. And if in the interim, if the prices keeps continuing to falling, I do not see that a contract of that nature would comply with the requirements of a contract as understood in the Contract Act, because every contract needs to have a consideration. My sense is that deferred consideration under this contract would have been that at the end of that period, moratorium period, if you can say so, if the promoters of Z manage to repay the lenders, then they would probably end up paying an additional premium. But that again is a contingent contract, and I don't think that they would have received that consideration at this point of time while executing the contract. So at best, I would say it's a contingent contract, and I think the fund houses and the lenders should be in a position to argue that the circumstances that existed on the day of the agreement have significantly changed.
Okay, okay, fair call. Dhirendra, would you concur with that view? And the part two of that question would be: okay, let's assume that nothing's happened to the prices and business is as usual at Z and otherwise. But if indeed, due to whatever reasons, there is a downgrade of the paper that comes in, what stops a rating agency if indeed they find something not correct with the papers and downgrade, and therefore the covenants are breached, and the fund houses, ideally as per their fiduciary duty, should go out and liquidate these assets. But the formal consent that they've entered into with the Z Group prohibits them from doing so. What do you think a fund whose primary duty is towards the investor would then do? Even if this is with an assumption that this is happening in the period of the in the period for which the standstill agreement holds.
No, any agreement, the transaction, the lending to the Z promoters against this is to Z companies, Z Group, Essel Group companies is partly of the nature of loan against shares. And mutual fund companies are very much within their rights to call for higher margin as and when the value of the collateral declines. So from that context, and decline in rating of the underlying stocks, I think those ratings are not very meaningful. And of course the mutual fund companies have very straightforward, because this is not subject to an agreement between the lender and the borrower. This is subject to also the valuation norms stipulated by SEBI for valuing those funds. Those funds values will collapse if some of these instruments turn out to be default grade. And if these but rating companies also issue ratings of structured obligations based on the kind of collateral, based on the kind of contract that is supporting a transaction. So I think it is of that nature, and that actually those instruments get penalized on the valuation front. Because the underlying actually has lack of liquidity. And also this is a fundamental problem with the fixed income fund industry in India, where a substantial part of the underlying is illiquid, wherein as against all the mutual fund investors get instant liquidity, or they have live liquidity available going by the design of the fund. The only barrier is sometimes in the long dated longer maturity funds or long-term funds, long-term fixed income fund. There could be an exit load which may not be a very serious impediment which can prohibit those investors to walk out. So this is a real risk, and mutual fund companies, in their endeavor to optimize return or sometimes maximize return, do get into such situations. And so far their track record has been very good. Yes. If we look at the history and the scale of the industry, the handful of cases that we have seen can actually be passed off as something which is given. But of course mutual fund companies also now have the privilege of side pocketing. If they are faced with a situation where something gets into a default grade which has to be valued at zero, and so they can side pocket it, and that could be a problem for investors, that could be a problem for the reputation of the fund company. But things can take longer to resolve, and everybody's interest will be moderately guarded, not fully protected. And this is a risk which comes very naturally with any fixed income investing when you are lending money.
Actually, I was going to come to that as my next question to both Dhirendra and Nirav. Dhirendra, to you first. The side pocketing piece. Sorry, yeah, Nirav, you wanted to add something?
Yeah, just one quick point. Just to continue from what Dhirendra was saying, and my earlier question is that we also have to factor in one aspect, that this understanding or agreement that the AMCs and the lenders have arrived at with the promoters of Z, is it in the nature of restructuring of the loan or merely an agreement to defer legal proceedings? If it is the latter, then again a question could be raised that is such an agreement enforceable in law? Because under the Contract Act, any agreement to restrain legal proceedings is void. So that again is a fundamental question on the Indian Contract Act that would have to be answered either by the AMCs or the lenders or the promoters of Z, whether what is the sanctity of such a contract.
Well, so far, even in the con call today, we were waiting for some responses, but they haven't come about. And I believe Nirav, sorry, Dhirendra, you want to add something?
Yes, I want to add something that, these contracts are actually not very meaningful because mutual fund companies are unlikely to be discharged, unlikely to be getting into an agreement which will compromise on their fiduciary responsibility to their investors. That is something paramount, and Securities Exchange Board of India will be taking a very stern view of anything
Dhirendra, if I
which
may,
violates that principle.
No, Dhirendra, if I may,
That
then what's the nature of
yes.
the agreement that they have entered into? In truest parlance, you can work with an assumption that if Z manages to sell off the asset at some point of time, then the value of these will be recovered and therefore it will be nice. But who knows? In effect, an agreement of such a nature, something that I haven't seen the AMC industry do in the past, maybe banks have done, but AMCs haven't, is not exactly the right discharge of fiduciary duties. A lot of people have raised this question.
Yeah, no, but my understanding is that, mutual fund companies would have entered into an understanding that Z promoters will provide larger collateral of their residual holdings, residual promoters holding, just in case the prices go down further.
Okay. Well, unfortunately, we don't have access to that, and we don't have the answers on the con call, so I can't talk too much about it. But just a couple, a couple of questions on the side pocketing bit that Dhirendra mentioned as well. And Dhirendra, I want to come to you first on that, and then Nirav maybe. We were talking about this point in the morning in the edit meet, and we were just talking about this, that if indeed the fund decides to side pocket at some point of time in the next 2 or 3 months, if indeed the need so arises, then that's acceptance of the fact that there is an issue with this asset, and therefore they're going ahead and side pocketing. And the questions would be asked that if this was anyways anticipated, why did the House agree to the formal agreement as opposed to selling off whatever they had to at this point of time, currently the month of February?
Anyway, selling in a desperate situation or at a situation when this whole crisis blew up last week will also make them out of pocket anyway. So it is actually in the interest of everyone that everything works out happily, nicely, given some time. And because mutual funds, if they act in a desperate manner, they will have to take a hit. The collateral may not be good enough when you see a sudden collapse of 25% or over 25% in a day. It will not be able to make good. Little stability, semblance of normalcy will translate into something better or meaningful, substantially better than that particular situation. Acting in a huff might be hurting their interest. The other is that if they find that the collateral is good and it can be supported by higher collateral, more margins can be provided over a period of time. So maybe that will be the negotiated part of the whole transaction or our understanding. I don't think mutual funds will be acting in a manner that because as the saying goes in Hindi, which I can understand, that paisa ka kaam to paisa se hi hota hai. It is unlikely to be dependent on generosity of the passerby or based on goodwill that money will come by, we trust you and you're trustworthy enough, because the scale of money at stake is something which must be backed by some tangible thing which in the mutual funds assessment will be good enough to make good if something goes wrong.
Well, maybe you have a point. These are smart money managers. They've done these things in the past, but it's just that the uncertainty the whole issue brings, Dhirendra. I mean, you don't know at what point of time what will happen to the asset prices, and if and when the deal happens, who knows what the price of Z Entertainment is at that point of time for them to be able to get or recover the kind of monies that the promoter group is talking about. Couple of other things. Nirav, to you, Do you think the regulator would be fine with such an agreement? I'm guessing that they would have thought this through when they entered into it. But if indeed the regulator is looking hard at whether an institution which is supposed to manage public money safely is discharging the fiduciary duty in the best optimum fashion, will the regulator find problems with such an agreement?
So, I mean, let's look at it a little differently. Given what has happened with the script of Z in the past few weeks, and given the fact that any further panic selling would only erode the value of the shares, and eventually everybody loses. So I think a more pragmatic view has been taken probably by the lenders and the AMCs to ensure that there is no further panic selling, and this will only enable the promoters of Z to fetch a better rate for the promoter holdings. So to my mind, the story that they would have probably sold to the regulator is that in the larger interest of the integrity of the capital market, in the larger interest of the retail investor, it is best that no panic selling happens at this stage in order to support the promoters of Z. If due to some miracle, if the promoters of Z manage to get out of this difficult situation, then in that case, it's a good chance that the mutual funds and the AMCs and the lenders, everybody will make more money than what they would have made as opposed to selling the shares today in a panic situation.
Yeah, what if they don't? That's my only issue. So I'm sure that
the future.
Yeah, no, but I take on board. Let's not speculate out here, but a fair bit. But the only thing is the uncertainty around the price, and who knows what price and when would the deal happen. I would have understood if there would not have been a further agreement to the timeline as opposed to what was entered earlier. But after entering into an informal agreement to be on a standstill till March or April, as the case may be, in a few days later to come out with a formal consent which gets extended by 7 months, it just left a bit to be desired. My final set of questions, and Dhirendra, to you first. What should a retail investor who's got exposure to such funds do? Because quite frankly, while all of us may argue that this deal is a marriage of convenience, at some point of time Z will be able to monetize its stake at a better price than it would otherwise do if the shares are sold in a panic fashion, and all of that whole spiel. But what if it doesn't, and that uncertainty still hangs no matter what anybody says? What should a retail investor do? What would you, as somebody who advises swaths of retail investors, advise them? I mean, if somebody's coming and asking you personally about what should I do if I have a large exposure to some of these funds?
If I have exposure to any of these funds, I will see what is that allocation. Is it 2%, it is 5%, or if it is 10%? Depends on that. If it is a very meaningful exposure, I will try and wriggle myself out of it. And if it is a nominal exposure, then I will pray that everything works out nicely.
Okay, so large exposure.
Which is likely to be the case.
You probably need to take a hard call, but yeah, Dhirendra believes the likely to be the case is that
worry about it. Yeah.
Everything will work out nicely. Nirav, any final thoughts? I mean, can moratoriums of such nature become a permanent structure in the mutual fund industry? I mean, God knows we're talking about a lot of issues that are starting to crop up within the NBFC space as well. And for the right or the wrong reasons, mutual funds do have exposure to such paper too. What happens if Z is an example? Is it an example that is well set, or is it an example that could snowball into something larger?
So to my mind, I think it's already been happening. I don't think Z is the first case. I think such arrangements where legal action is
mutual funds and companies? I was aware of.
Yes.
Okay, fair call.
It has happened. It has happened a couple of occasions. It's not just the mutual funds. It's also which combination of mutual fund and lenders. So I don't think this is the first time it's happening, and it has happened in the past. It will likely happen in the future. It all depends on what the situation is with respect to the security that is being held by the AMCs and the lenders, the nature of the business, the difficulty that the company is facing. All those factors combined will eventually determine, because let's be honest, I don't think there can be a straitjacket formula of this nature. Effectively, it has to be horses for courses as we go ahead.
Yeah, and I'm guessing that's the whole basis on which a lot of people are hoping that this deal has been entered into, that the smart money managers know a thing or two more than what retail would know. I would just hope that the Z management would come out and give some clarifications about the nature of this as well. On the con call, there wasn't too much coming forth. But gentlemen, really appreciate you taking the time out and joining us today on this broadcast. Thanks so much for being with us. And viewers, thanks so much for tuning in to Bloomberg Quint.